Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Ted, thanks so much for joining us again today.
Thank you, Adam.
What's the current state of the U.S. pension system?
The two major challenges that are facing U.S. pensions are lack of transparency. Transparency has plummeted in the information age, believe it or not. Pensions in the United States are less transparent today than they were 20, 30 years ago, believe it or not. And the other side of the coin, the reason they're less transparent than ever is because they've been loading up on high cost, high risk alternative investments. These are investments that are alternative to publicly traded stocks and bonds. So we're talking about hedge funds, private equity funds, real estate funds, venture funds. These investment managers, Wall Streeters, have demanded secrecy as more and more public pensions are piling into alternative investments. Transparency is plummeting, which makes for a very, very dangerous situation.
Would you put it all at the feet of the central banks, or is part of it due to Wall Street finding an opening in the door and coming in and just pushing products that it made a lot of money on, regardless of how safe it was?
It's very clear what caused the near collapse of the UK pensions, directly tied to massive government intervention. Wall Street has a solution to every investor problem, and the solution is always pay us more in fees. So what Wall Street did was they came out with the highest cost, highest risk investments ever devised, the most secretive investments ever devised. And so it was, an opportunity for Wall Street to come in and say, if you agree to these secretive, high cost, high risk investments, we will help you meet that ridiculously high actuarial assumption, which used to be closer to 8%. Now it's closer to 7%. That is what's been driving public pensions and pensions of all kinds into these secretive high cost investments.
When you've been on this program in the past, you've said, yeah, everyone sort of talks about, bonds when it comes to pension funds because, there's the quote unquote, the safe investments. But you basically said, pension funds don't really invest that much in bonds anymore. I mean, they're so much more loaded up on these alternative investments than folks imagine. Is that a correct statement?
Yeah, that's absolutely true. Pension funds today have a very minor holdings in pure bonds. So they get into a lot of high yield hedge funds and all kinds of crazy other quasi fixed income investments, but they're not bonds. They have very different risk profiles, very different potential returns. The actual percentage in bonds is very small these days. So that's that the old-fashioned notion that pensions are primarily in bonds or significantly in bonds is just not true anymore.
Right. And the assumption that pensions are primarily invested in safe investments because they're supposed to be the good stewards of people's retirements. I assume that assumption is relatively wrong at this point in time, too.
That's right. And one of the things Robert and I talk about in Who Stole My Pension is how pensions routinely lie about their risk profiles. So if a pension fund on its website says that they're 30% in bonds or whatever, or 20% in alternative investments, the actual allocation to alternative investments is probably closer to 40%. And the percentage in pure bonds is significantly lower. So what we talk about in Who Stole My Pension is that pensions lie about the fees they pay, they lie about their performance, and they lie about their risk profile. You're not seeing current market value. At the end of 2021, 2022 fiscal year, you're seeing the value of these alternative assets 3 to 6 months in the past.
three to 6 months in the past, but also valued at whatever the holder deems they're worth, right? They're not being marked to any sort of publicly traded market price.
Well, I think the correct term is marked to make believe.
Okay.
That's what we call it in the forensic world. Yeah. So there are two huge problems there. So when you said, okay, let's say what did the market do in the last fiscal year? Down, whatever. I don't know what the number was, down 10% or.
Yeah, you're being generous there, but yeah, I think right now we're, I don't know, maybe down, I don't know, 15% on the S&P.
Yeah.
Bonds are still down about 13%.
Right. So what you see, if you go to pensions most recent financial statements, you'll see bonds down 10%, equities down 15%, alternative investments up 40%.
Okay.
So how'd the pension do? Well, we lost 3% for the year, so we beat the market. No, that's not quite what happened. You're comparing apples to oranges. But if you look at most state pension funds for the last fiscal year, you'll see that their performance was down a few percent. And how is that possible? Because they're not marking down the alternatives, and the alternatives values soared according to their financial statements.
Got it. I got to imagine your experience would tell you that in a year like this, it's the more speculative alternative assets that are probably taking the most damage. So, there's a lot of window dressing going on here. They're purporting to look a lot healthier than they probably really are under the hood based upon the type of year we've had.
Absolutely. And I recently completed a forensic investigation of the Ohio Teachers Pension Fund, which is a $100 billion pension fund in Ohio, and 30,000 retired school teachers raised the money to have me do a forensic investigation. And for the last fiscal year, the pension fund approved $10 million in bonuses based upon their reported performance. They paid out the bonuses. Then a few months later, they announced, oops, the pension fund didn't lose $3 billion, it lost $5 billion. And so now the teachers are trying to claw back the money. And those staff bonuses were never deserved. They were based on bogus financial information. And now that the day of reckoning has come, that in fact, at year end, they were down $5 billion. To pay $10 million in bonuses for losing $5 billion irks a lot of retired school teachers in Ohio.
Is the problem getting better with folks like you coming out there and shining some light on some of these players, or is it continuing to get worse for the reasons you mentioned earlier?
So what I do is I go in and take a look. What is supposed to happen with public pensions, public monies, there's supposed to be public scrutiny and public accountability. Every state has a public records law that is similar to the Federal Freedom of Information Act. You should be able to, whatever state you're sitting in, request information about your pension fund, your state pension fund, and get that information. Unfortunately, these states have become very adept at undermining public records requests, stonewalling. So if you can't get access to the documents, if you can't read the prospectus before you invest, because the pension won't allow you to see how your retirement money is being invested, all you can do is hire a forensic expert who comes in and says, I can connect the dots even when all the information hasn't been provided.
All right. And let me just say, Ted, thank goodness that there are players out there like you that are helping bring transparency into this both very opaque but very critical, arena, because there's millions of people or thousands and hundreds of thousands of people whose pensions are, dependent upon how these players are, or these actors are managing their funds.